back to the Capital Mindset Show, everyone. So we're going to be going over another value trap. So the last one I went over was sleep number, and then this one is another one. So the sleep number was an update from the live stream we did when we covered sleep number when it was significantly higher, and then now it's lower. So this is the second one that we're going to be doing. So this is NLS. So at the time I did this video, it was published on January 19, 2022. And unfortunately, I didn't publish this video way earlier when I could have, but I did publish it still when it was, much higher, at least from today's prices. And so it was sitting at about $5.73 or close to $6. And so we're going to go over this. So this is actually, I was just looking at sleep number as per the previous video. So if you guys haven't checked out that video, go check it out. So this one is Nautilus. So this is actually down 7.08% according to, well, the Friday before this video. And with this company, one of the things that we were talking about, if you actually go back to watching this video, is basically you had a decent amount of cash, right, initially by the bullish thesis. So the bullish thesis was centered around them having a ton of cash. And with this cash, you were basically buying, there was like a baseline valuation for this company. And I think it was in the hundreds of millions of dollars in cash. Now, one thing I was talking about within that video was you have to be careful with that, because what this company does is they sell exercise equipment, very similar to something like Peloton, but a little bit different. They do have a competing line against Peloton. They own brands like Bowflex, you might have heard of them, as well as Nautilus. You might have heard of them as well. So, but for the most part, they did benefit a tremendous amount from people kind of doing the work from home thing, buying their own equipment, taking it home. So sales were up, elevated during the COVID pandemic. And as kind of things calmed down, of course, it started to teeter down as well. So all that cash, though, was kind of handled over into inventory, converted into inventory. And there were some interesting comments that I did receive that I guess, people were, I guess, kind of upset by. Oh, the person deleted their comment. Okay, so there was a person that actually, I remembered your comment, by the way, if you're watching this video all this time later, but I remember we went back and forth about it, and yeah, so they deleted their comment. Never mind, I was going to show you a comment. But for the most part, someone was kind of confused, or at least trying to come at me about the inventory comment that I made in this video. But for the most part, it was basically centered around that all that cash would eventually be turned into inventory as they were having inventory issues, right? And so don't actually count on that cash actually being there to be returned to you as shareholders. They actually were going to use that cash, and they did. So the cash actually went down. So going over this company now, we can see that, well, how have things deteriorated or not so much? So we're going to go to their website. We're going to see what we can find here. And we're going to go to Nautilus. We're going to go to the investor relations. So we just go here to investors. We go to the SEC filings, pretty easy. And we're going to find out, well, what the heck's going on? 2022. Let's go to the quarterly filings. Let's go to that because I want the most recent. Let's go to this one. Yeah, that's fine. Give it to me. All right. And we're going to use the PDF. Give me the PDF. I like the PDFs. All right, load. All right, so cool. So we have the balance sheet, and basically what we see here is a shadow of its former self. If you are curious about the levels of cash flows, it was 100 million, as you can see kind of from this. You can see it was close to 100 million. It was like 70-ish million. But I think the actual current and short-term investments totaled, and I know, sorry about this, it's at not at 1080p, but you can see the number there. It was at like 111 million in current assets because they had short-term investments around there. So they're putting it in short-term duration bonds, et cetera, CDs for all we know. But basically it was short-term duration assets, and they had a tremendous amount of cash. They went all the way down to 20 million. So now we're going back here, and they're now down to a total of, we have cash equivalents of 7 million, trade receivables about 27 million, and then see that inventory levels now at that 100-ish million. So they have all that, and then eventually those can produce sales, but the question is, can they realize the full value of that inventory? That's a little bit of a more of a question mark. Okay, they could, it might, but they have to realize the value of that inventory. They have to sell it, okay, and then get cash for that inventory. Now, the total assets are equating to about 229 million. We see total current assets at 157 million, total current liabilities of 62 million. So it looks good on that front. Now, we do have the payables. The payables are actually stuff that they do have to pay. They have accrued liabilities, and we have a bunch of other things, but a lot of these payables have to come from cash. The question mark is that inventory. So that inventory wouldn't actually classify it too much as something that is solid, that exact value of $103 million. We don't know what the end value is actually going to be. And now if we look at the actual sales component, we do see that sales are coming down. This is not a good sign, obviously, because we would want our company to be in stagnant or maybe growing a little bit, but basically a lot of demand was pulled forward during the pandemic, and now we're kind of seeing something where the company is suffering tremendously, and they don't have the ability to basically keep the price that they currently have because, of course, we're seeing it decay, and decay is not good. Sorry, it's not good. But all seriousness, or we were serious, but we are looking at this from this other perspective. We do see that, of course, they're having a net loss of 60 million. Doesn't look good on the surface there. Now, what about cash flows? How are they doing on cash flows? Well, we do see loss from continuing operations. Well, it continues down here, but that net cash used by operating activities is still negative. They're negative cash flows even in the previous year, to kind of show you a little bit about how GAAP net income can be different. And so when you reconcile some of these cash items, you can see that, well, for example, look at that inventory item of down negative $43 million for the previous year. And then this year, they didn't really need that, but you can see that because of that, investment in inventory, we do see a net cash used in operating activities was actually negative $28 million. So, of course, what are they going to sell the inventory for? That's, again, going to the question mark. But all in all, this company, it looks cheap on the surface. And if we actually pull in NLS here, we're going to see just how cheap it looks. But again, this is the cautionary tale of these value traps. One other context about this industry, or this sector, is having to do with the exercise equipment sector as a whole. So they typically all, or most over the period of time, have gone bankrupt because it's a very difficult business. It's a terrible business at that. And analysts are kind of projecting declining revenue growth. So I've seen anywhere from down 14% year over year growth projections. And, that's for the next couple of years. And then more recently, of course, it's down about 40-ish% in terms of revenue. So if we take a look at the revenue, so these aggregates of estimates, I don't really agree with. I agree with the other analysts who are kind of coming in. So that's a bit of a nuance that I want to talk about, because it depends on what analysts you really look at. And we do have analysts having a neutral rating with a price target of $3.42 that now it looks like a compelling buy. But at the time, it was actually analysts kind of being a little bit pessimistic, which I did agree. Now, we do have Truist, Lake Street, these institutions saying here that, okay, buy. A lot of them are saying buy. But yeah, this is definitely bottom fishing. If we do see the bankruptcy analysis, it doesn't really say that there's a risk of bankruptcy in the near term, in the very near term, but who knows what changes in 3 years from now. So, of course, you might look at this company and say, well, now is the time to buy in this cyclical side. Now the market's getting really pessimistic, but they're going to actually benefit from something different in the future. So you see analysts are actually having the estimate. Maybe they're right, and maybe you agree with them that estimates are rising in the next year. So we should probably maybe think about investing now. Maybe, I don't know. So shares outstanding, it's pretty much been flat. They haven't been really doing anything there. So with this kind of company, I mean, right now we're going to have to do some actual changes to the analysis here. So let's do some. All right, so basically after making those adjustments, we see that, okay, but it still doesn't really like it. We do need to see some growth, and we're really not priced for that. So this is, if you haven't been able to tell, it's for me, and it's an avoid. I'm going to avoid this company. It's too much of a question mark in a lot of ways, and it's not really an industry I really like. I didn't like Peloton when Peloton was roaring. I didn't like this one when this one was kind of roaring, because if you're saying, well, when was this roaring? Well, I'll show you right here. So if we go to the price action, we see that, at one point it was at $29. So it was down here at one point, and then it just roared up all the way higher. And I think it's going right back down to these levels. So we'll see what happens, but that's another episode for the bottom fishing club, so to speak. So that's Nautilus. So cheap stock, yeah, it looks cheap. But doesn't look cheap when you make certain assumptions, I would say. But yeah, some investors maybe on, I don't know, some blog posts out there might say that it's a cheap stock. Maybe they're right. So I know that, for example, I came across this one and I wanted to show you guys. So there's this one. So this guy's saying a pair trade. So pair trade means you go long one, short the other. So short Peloton, buy Nautilus, and more reasonably valued for recovery. So I don't really agree with this person. I just don't think you should buy either. I think and don't even short Peloton. Why would you take on that risk? Just don't do it. Just stay away and just go focus on other things with your time. Just how about that? But of course he can say this. It's his opinion and stuff. I'm actually curious what the comments are saying. So let's go to the comments. So I hope this most shareholder Nautilus vote their shares out. Board of directors. Blah 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 blah. Do you agree with the sentiment? Yeah, the entire space is in trouble. I agree with that comment. I'm just reading these comments. But anyways, I was just wanted to show you guys this article. But all in all, thank you guys so much for watching, and I will see you guys on the next video.